looks like. All right, so ordinary income or loss. Remember when we were talking about in chapter 8, where we talked about flow-through entities, and we looked at that K1, and we've got ordinary income in that box 1, and then we've got all these other separately stated items. We've got boxes for interest income, we've got boxes for long-term capital gains, short-term capital gains, royalty income, rental income, dividend, qualified dividends, ordinary dividends. We've got all these other boxes for separately stated items, but then we've got that box 1 for ordinary income. That is essentially our net income from operations. Right, so from whatever it is that we do, our main focus, so in our case it's selling pies, right? Whatever we made from selling pies, that net income is going to be divided up amongst us 3 partners based on our partnership, our ownership of that partnership, and we will have our ordinary income entered there. So, but if our partnership also has, say we have a bank account for a partnership and we earn interest in that bank account. We earned $100 of interest, well, let's make it easy, $90 of interest over the course of the year. And each of us, we own this partnership a third. Well, we've got our ordinary income, but we also have interest income that we earned. That interest income is not part of ordinary income. So for each of us, it's going to be $30 on each of the K1 forms that are being issued. So those are separately stated items. But the ordinary income is all the ordinary income and expense items from our regular course of business, from selling our pies, from manufacturing and selling our pies. So this is what the 1065 looks like. Again, it's a glorified Schedule C, which is an income statement, right? So all of our income items up here, same types of items. So we've got our gross receipts, less returns and allowances, cost of goods sold, gross profit. If it's a farm, then there's a special spot for a farm, other types of income there as well. And then we have our expenses down here. So salaries and wages, guaranteed payments, which we're going to talk a little bit about. We sort of touched on guaranteed payments, I think in chapter 8. We'll go into a little bit more detail on those guaranteed payments in this chapter as well, what those are. But all of the other expenses that we would list for our partnership to arrive at our ordinary business income or loss. Now you can see there are a lot of other things here as well. Like I said, partnerships are pretty complex. They have some really complex accounting rules, tax accounting rules. There is a spot here, so if there is any tax due. Now remember, all of this the ordinary income is going to flow through to the partners based on their ownership percentage. All of those other separately stated items, same thing, it's going to flow through to the partners based on their ownership percentage. There are some other taxes that may be due to the IRS, some excise taxes, but they're not income taxes. They're different types of taxes. So that's what this tax and payment is for. But for most partnerships, like smaller partnerships and stuff, they don't, like fuel taxes or credits may be listed, maybe one of those as well, but not like income taxes, not taxes on the income that you earned from your ordinary operations. So page 2, like here, it's just a bunch of questions about the partnership, a lot of yes or no questions. Questions about ownership. So if there's a corporation that owns part of the partnership, which is possible, you can have a corporation that owns partnership, is a partner in a partnership, you would list that there. Does anybody own directly, let's see, what is this? A other questions about, so own directly an interest of 20% or more, own directly or indirectly interest of 50% or more in the profit, loss, or capital in any foreign or domestic partnership, yes or no. So if this partnership owns another partnership, they want to know about that as well. Again, lots of yes or no questions that I'm not going to go through that are on page 2 and page 3. These are like all the complex partnership rules are kind of wrapped up in all of these questions. And then all of our separately stated items. So we have this Schedule K. So all of those separately stated items that are on the schedule, that are on the Form K1, all of them added together show up on this Schedule K. So this is essentially the total of everything from all of those K1s. So we've got our ordinary income, rental income. So again, all of our ordinary income and then all of our separately stated items in total are listed on this Schedule K here. So if you were to look at the Schedule K1 and put it next to the Schedule K, you'd be able to follow and see that, oh, yes, so box 14 of the Schedule K1 has to do with self-employment income. Well, on the K, box 14 also has to do with self-employment income. So it feeds right into that Schedule K1. Balance sheet. So this is where I said, there's this balance sheet that only businesses that like larger partnerships, I think their assets, let's see. I can't remember what the cutoff is. Some partnerships have to do a balance sheet. Some partnerships don't have to do a balance sheet. It's always a good idea to do a balance sheet, though, with these, even if you're not required to do so, because it just kind of keeps you, it's another way to verify the information. So we've got last year's balance sheet, this year's balance sheet, even though it says beginning of tax year, end of tax year, it's really last year, the end of last year's balance sheet. So that would come from last year's tax return, just be popped there on that balance sheet. So this is the financial per the books. So this is the balance sheet per the book. So whatever you have on your financial statements as balance sheet, that's what's going to go here on this balance sheet. Now, we also have a reconciliation between the books and the tax return because we have lots of different rules, right? Depreciation. We do not use financial accounting depreciation for tax purposes. We have a whole different depreciation regime that we use. And so that creates a difference between the income statement on the financial statements and the income statement, what's represented on the tax return. We have some other different differences, right? Entertainment expenses are not deductible on the tax return, but entertainment expenses are an expense on the financial statements. That's a difference, a book tax difference. We call those book tax differences. This form here, this M1, helps us to reconcile, and this is a requirement. If you do the balance sheet, you have to also do this M1. You start with the net income or loss per the book, so whatever's on the financial statement, which should agree with what's on the balance sheet, right? So you start with that, you make all these adjustments plus or minus, and we're going to go into this even more in next chapter about this difference. I will tell you that this part is what, at least for the next chapter, this is probably what gives students the most consternation, is figuring out this M1. It also creates a lot of headache for accountants that are doing it. I would always find, doing the M1s always created a lot of anxiety for me, trying to figure it out, because some of these things are added, some of them are subtracted, all these differences. Remember, meals are only 50% deductible for tax purposes, but they are 100% expensed on the financial statement. So we've got all these differences between tax and financial accounting, and this M1 reconciles those two differences. So you start out with the net income per books, make all these adjustments, end up with the income or loss per the tax return. This has to agree with, where is it, line 1 on the first page. What line is it? Whoops. Has to agree with this, 23. I think it's 23. Yeah. So there's a lot of moving parts in figuring that out, and we'll go into more detail on that, like I said, in the last chapter, the M1. Guaranteed payments. Okay, so we have these guaranteed. You remember, partners don't receive a wage. They're not partners in a partnership. Are not employees of that partnership. They cannot be employees of the partnership. They're like sole proprietors with partners, with other people that are working in that same business. But they can receive guaranteed payment, which is like a salary. So it's like so for example, our partnership with the three of us, we'll say that Anthony, you're gonna get $1,000 a month. Or no, actually, Jennifer's going to get that because she's the one that's actually working. We're going to give her that $1,000 a month for her services, right? So she's going to get that. She's guaranteed that money. It is not based on how much we make. It's not like, oh, you're going to get 10% of our net profit. You're getting a set amount in exchange for services. Those are called guaranteed payments. And the thing about guaranteed payments that's unique, so when you are a sole proprietor and you've got your own business, if you pay yourself, you don't get to deduct that as an expense. Like you just pull out the cash and you don't get to deduct, you still have to pay tax on all of your net profit. You don't get a special deduction for that payment. As a partner though, if the partnership makes guaranteed payments, now, it cannot be, like I said, it cannot be based on a percentage of the partnership. It has to be guaranteed. You get it for the services. You provide the services, you get the payment, just like any other wage would be. But the guaranteed payments are deductible to the partnership. So now you get to deduct. So if we paid her $1,000 a month, then she's going to get $12,000 in guaranteed payments over the course of the year. But we get to deduct, the three of us, on that partnership return, get to deduct the value of those services, what we paid her, the $12,000. So now, yes, she's going to pay tax on it. She's going to pay self-employment tax on it. She's going to pay Social Security, Medicare tax on it. She's going to pay income tax on it because she received that as income. But she's also going to get to have the benefit of 1/3 of that will be deductible from the ordinary income of the partnership. So she's going to get, and you and I are going to get 1/3 of her salary as a deduction as well, because that it'll offset that amount of income. Partners are not employees of the partnership. They cannot receive a salary. They are owners of the partnership, and they are considered self-employed. They're self-employed individuals that have merged together to run a business. Guaranteed payments are payments to partners for services rendered. In order to qualify as a guaranteed payment, the payment must be calculated without regard to partnership income. So if we get into months where we can't pay her, but she's performed the service, we're just going to have to borrow money in order to pay her. We can't, we have to pay her if she performs the service. Here's an example. We've got Junius, a 20% partner in DJ Real Estate Partnership. He does a lot of work for the partnership, and he receives $1,000 a month for his services. $1,000 a month is a guaranteed payment. As such, the partnership will deduct it from ordinary income on line 10. So you see, it was on the partnership return here. Line 10. Oh, not that line 10. Different line 10. Here we go. Guaranteed payments to partners. We get to deduct that as an expense, as an ordinary expense. That's going to reduce the amount of taxable ordinary income that flows through to the partners. Oops, where'd he go? He's going to include $12,000 of guaranteed payment on his 1040 Schedule E. He is also going to have to pay self-employment tax on that $12,000. So self-employment tax as well as income tax. We've got Dawn as an 80% partner. She also works for the partnership and receives a monthly payment of 50% of the net income. Well, that's not a guaranteed payment because it's based on the net income, right? Because it is calculated with regard to income, it is not considered a guaranteed payment. Therefore, the partnership does not get a deduction for that payment. What that is a distribution to her. She's essentially getting a distribution which is coming out of her basis of that partnership. The only items that are reported both as a deduction for ordinary income and as a separately stated item. So they're kind of both. They reduce ordinary income, but for the partner who's receiving the guaranteed payment, it's listed as a separately stated item. So when you're filing your own individual tax return, you're going to pay self-employment tax on ordinary income, and you're going to pay self-employment tax on the guaranteed payments. So you're subject to self-employment tax on both of those items. Okay. Depreciation. So partnership will calculate depreciation following the same rules as a sole proprietorship. So those depreciation rules don't change regardless of the organization, how the business is organized, except for the 179 expense deduction, because remember we've got that 179 limits are based on an individual basis. So they are applied on an individual basis, and so the 179 expense deduction is listed separately on the K-1 because each partner, some partners may be entitled to it, other partners may not be entitled to it if they have other 179 that's claimed on their tax return. So those 179 limits are on an individual taxpayer basis. So the 179 expense deduction is not going to be listed under ordinary income. It's not going to reduce ordinary income, but it's going to be listed separately under a separately stated item that will, if the individual partner is able to take advantage of that deduction, they'll still get the deduction, but it's going to be combined with other Section 179 expense on their tax return. So if they've exceeded their limits on 179, then they're not going to be able, then it will be limited. So that's why they have to state it separately. They can't just mix it in with everything else. And that's what's explained here. Partner health premiums. So most employees can exclude from income the cost of employer-provided health and accident insurance. For employees of a partnership, we're not talking about partners. So partnerships have employees, right? They hire people, they have W-2s, but those individuals are not partners in the partnership. Partners are not employees. Partners cannot exclude from income the cost of their health insurance premiums paid by the partnership. So the partnership will treat the premium as a guaranteed payment. So if the partnership pays for, if you're a partner in a partnership and the partnership pays for your health insurance premium, that is treated as though it's a guaranteed payment. So you're going to pay self-employment tax on it. You're going to pay income tax on it. It's going to be included in that box for guaranteed payments, but then you also will get to turn around and take a self-employed health insurance premium deduction as one of those 4 AGI adjustments on your Form 1040. So business interest expense limitations. So for businesses with average annual gross receipts over the past 3 years over $30 million, business interest expense is only allowed to the extent it does not exceed 30% of adjusted taxable income. So partnerships don't have adjusted gross income, but they have this adjusted taxable income. But the interest expense is limited to 30%, but only for those that have annual gross receipts over $30 million. And yeah, they talk about this more in chapter 15. All right. So here's just kind of a list of ordinary things that are included in ordinary items that feed into that ordinary income box, box 1 on the K1, box 1 on the 1065. So all of these things, we have our gross profit minus also any other ordinary income from Form 4797. And then all of these expenses would be deductible for the partnership, but then all of these things are separately stated items. They show up on the Schedule 1, and then they feed into the Schedule K1 on a per partner pro rata basis based on their ownership percentage. So that's just what a list of those items.